Hey everyone, and welcome to today's Explainer. I am so excited to have you here. If you're a diploma student currently tackling FAR210, you are exactly in the right place. So, grab your favorite pastel highlighters, open up your digital notebooks, and let's get comfortable. Because today, we are going to completely master MFRS 116, specifically Property, Plant, and Equipment Initial Costs. And hey, don't worry if this topic has felt a little intimidating before. We're going to break it all down step by step, make it super clear, and turn you into an absolute MFRS 116 expert.
Okay, let's just dive right in with a real-life business scenario. Imagine you own a cute little manufacturing business, and you just bought a brand new factory machine. The supplier's invoice says RM $250,000. So you just record RM $250,000 as your asset in the accounts, right? Well, actually no, not quite. In the world of accounting, getting an asset ready for use involves a whole lot more than just the sticker price. And finding out what that true cost is exactly what MFRS 116 is all about.
Here is our game plan for today. 1. Basics and definitions. 2. The 3 elements of cost. 3. Included versus excluded costs. 4. Calculating cash purchases. 5. Swaps, trade-ins, and credit. And finally, 6. Final exam tips.
Let's start with Section 1, Basics and Definitions, setting the foundation.
We really need to build a strong foundation here. Under MFRS 116, when we first recognize an item of property, plant, and equipment, which we usually just call PPE, we have to measure it at cost. But what does measurement actually mean in this context? Officially, it's the process of determining the monetary amounts at which these items are carried in your statement of financial position. But let's translate that textbook jargon into something much simpler. Measurement is literally just answering the question, how much did this asset actually cost us?
Moving right along to Section 2, the 3 elements of cost, the core rules.
Now, this is a highly tested area in your FAR210 exams, so definitely pay close attention here. The initial cost is made up of 3 specific elements. Step 1 is the purchase price. Now, this includes non-refundable import duties and taxes, but, and this is key, you have to subtract any trade discounts and rebates. Step 2 covers directly attributable costs. Think of these as the expenses absolutely necessary to bring the asset to its location and get it into working condition. So things like site preparation, delivery, or installation. And then we have Step 3. This one often surprises students, dismantling and restoring costs. If your company is legally or contractually obligated to tear down the asset and restore the site at the very end of its useful life, you actually have to estimate those future costs, calculate their present value, and add them to the initial cost right now today.
Section 3, Included versus excluded costs. Avoid common exam traps.
Put a big, bold asterisk in your notes for this party, because this is exactly where exam traps love to hide. But notice how logical the pattern is once you really look at it. On the included side, we've got costs like testing, site prep, professional fees, and delivery. Why? Because without them, the machine literally cannot work. It's that simple. But look over at the excluded side, startup costs, staff training, advertising, and relocating. Why do we exclude these? Well, because they're just general business expenses. Think about it. If you need to train your staff to use a machine, that's an expense related to your employees, not a cost required to physically make the machine functional. Advertising a new product doesn't build the machine either. So these excluded costs skip the asset account entirely and go straight to the statement of profit or loss as expenses.
Section 4, Calculating cash purchases. Let's do the math.
All right, theory is great and all, but let's actually see this in action. Grab your calculators. Let's walk through an example with a company called TTN BHD. They buy a machine with a base purchase price of RM $250,000. First things first, we deduct a 3% trade discount, which comes out to $7,500. But here is the absolutely crucial point. What happens next? The supplier offers a 2% cash discount. In FAR210, you must deduct the cash discount whether the company actually takes advantage of it or not. So we deduct that RM $4,850. Then we start adding in our directly attributable costs. We have import duty and shipping totaling RM $22,900 plus installation at $9,500. Add it all up, and our true final initial cost for the MIPPE is RM $270,050. So once we have our final number, we need to record it in our journal. We debit our machinery asset account with our calculated total of RM $270,050, and we credit bank for the exact same amount. But wait, remember those tricky excluded costs we talked about a minute ago? Let's say TTN-BHD also paid RM 11,500 for startup costs and RM 4,800 for administrative costs. Because these do not bring the asset to our working condition, we debit them completely separately as expenses in the statement of profit or loss, and we credit bank for $16,300. The golden rule here? Keep your asset costs and your everyday expenses clearly separated.
Let's look at how this builds up in a massive, real-world example. Check out Digitalcom brand. They are building a huge telecommunications network. They've got RM 300 million in machinery, RM 105 million in site prep and assembly, and RM 15 million in professional fees. But here's the twist. They signed a 10-year contract, and after those 10 years are up, they are legally required to decommission or basically tear down the facility. That future cost is estimated at RM $33,780,000. Now, under Step 3 of MFRS 116, we don't wait 10 years to record this, no way. We add the present value of that future dismantling cost into the initial cost today. That brings our massive total asset value to RM $453,780,000.
All right, Section 5, Swaps, Trade-ins, and Credit, Advanced Scenarios.
You guys are doing fantastic, by the way. We've covered the basics, the math, and the traps. Now let's level up and look at some advanced business scenarios. First off, what if a company just doesn't pay cash immediately? Well, if you buy on normal credit, meaning you're going to pay within a year, the cost of the asset is simply the cash price equivalent. Any extra interest you end up paying is just recorded as a separate expense. But if you buy on deferred payment, meaning the credit terms stretch beyond a year, it changes. The asset's cost is recorded at the present value of all your future payments. The difference between what you record as the asset today and the total payments you'll eventually make is recognized as an interest expense over the life of the credit.
Okay, now let's talk about swaps. This is when you exchange one non-monetary asset for another, like trading one building for a different building. MFRS 16 requires us to ask one vital question first. Does the exchange have commercial substance? Basically, does this trade make genuine economic business sense? If the answer is yes, we use the fair value basis. We measure the new asset at its fair market value, and we actually recognize a profit or loss on the old asset that we gave up. But if it lacks commercial substance, we use the net carrying amount. The new asset is just recorded at the book value of the old asset, and zero profit is recognized. It's a straight swap on the books.
And this next scenario brilliantly illustrates exactly how the fair value basis works in practice. Let's look at GHI-BHD. They decide to swap their old building, which has a book value of RM $10 million, for a brand new one with a fair value of RM $22 million. And they also agree to pay RM $2 million in cash to sweeten the deal. In our journal, we debit the new building at its RM $22 million fair value. Then, we credit the old building to completely remove its RM $10 million value from our books. And we credit the bank for the RM $2 million cash paid. Because this trade has commercial substance, our debits and credits don't match yet. We get to balance this entry by crediting a massive RM $10 million profit on disposal.
Now, a very relatable everyday version of a swap is a trade-in transaction. Think of JKL, BHD, trading in an old Mercedes-Benz for a shiny new one. The new Benz has a cash price, fair value of $250,000, so we go ahead and debit that amount. The old car had a carrying value of $20,000 on our books, which we credit. The car dealer gave us a trade-in allowance of $65,000 for the old car, so JKL only actually pays the $185,000 difference in cash. Just like the building swap we just looked at, that trade-in allowance basically acts as our sales price, which allows JKL to recognize a nice RM $45,000 profit on disposal in the SOPL.
Finally, what if a company pays for an asset by issuing its own shares or bonds instead of cash? The rule here is all about reliability. Generally, the initial cost is recorded at the fair value of the asset you received. But if the fair value of the shares or bonds you gave up is more clearly evident, for example, let's say the company's shares are actively traded on the stock market with a very clear, quoted daily price, then you use the quoted price of the shares to value the asset. You always go with whichever piece of evidence is the most reliable.
Section 6, Final Exam Tips and Summary.
Wow, we have covered a ton of ground today. You've learned the basic foundations, navigated some pretty tricky calculations, and mastered those advanced scenarios. I highly recommend taking a screenshot of this checklist or jotting it down in your notes, because these are the exact points examiners love to test. 1. Always deduct cash and trade discounts. And yes,
even if the cash discount isn't actually taken. 2. Be absolutely ruthless about excluding startup, training, and advertising costs from the asset's value. 3. Don't forget that Step 3 dismantling costs must be added, but at their present value. 4. When you're dealing with swaps, your very first step is always checking for commercial substance. And 5. Ensure all those excluded startup and admin costs go straight to the statement of profit or loss as expenses.
And just like that, you have completely conquered MFRS 116 initial costs. By understanding the real story behind the numbers, learning how to separate true asset costs from general expenses, and mastering those journal entries, you are well on your way to acing FAR210. Now that you know exactly how to measure an asset on day one, the logical next step is figuring out how to reduce that value over time. So the question is, are you ready to tackle depreciation next? Review your notes, stay confident, and keep exploring the fascinating world of accounting. You've got this!